Well, hi traders. So we've just seen the Fed meeting coming out. No major surprises. Obviously, we've seen two dissents coming through. First time I think we've seen two governors dissent since 1993. But the market hasn't really seen any huge upsets through there. What we have seen is a stronger US dollar. We've seen higher treasury yields on the back of this as well. And we look at what's going on in some of the technicals and the dollar pairs, which is certainly getting a lot of attention from clients. We've also seen a reasonable breakdown in the gold price, which is getting quite a lot of attention from clients at the moment. We ask whether that can continue. US earnings are coming in thick and fast. Now, we've just seen numbers coming out in the aftermarket from Meta and Microsoft. Are they defining earnings? I think they actually are. The NASDAQ has rejoiced on the back of that, but these stocks are clearly doing everything right. They've smashed expectation. The baton now gets passed to Amazon, to Apple, and some of the retail traded favourites coming through like Roblox, Coinbase, and some other names as well. So we look at the earnings season and ask, is there more juice left in the tank to continue pushing US equity markets higher? Now, of course, on Friday is the Mac Daddy of economic release. Is something the Fed are going to be looking at very closely and would go some way into that, determining whether we get that September rate cut coming through. Of course, that's the non-farm payrolls number. All of these factors are playing into markets. We're getting turns coming through, but can they continue? Blake and I discuss all of those factors in today's trade-off. Well, g'day. Chris Weston from Pepperstone here. I'll be joined in 2 seconds by Blake Morrow from Forex Analytics. And we've been away for a couple of weeks, rejoicing in terms of what's been going on, lying around, trying to chew the fat, get our minds back in order and see what's going on in these markets. But we're back refreshed and we're welcoming all of you back to the programme to discuss everything that's going on in the financial markets, the movers and shakers, where we like the directional trends, the probabilities in these markets. And we're welcoming back Mr. Blake Morrow. How have you been, my good sir? I've missed you, buddy.
I missed you too. I've missed the whole crew over there at the trade-off. It's been a nice break, but nice to get back at it.
Oh, these things happen. But for you guys out there who've remained with us and remained loyal, we appreciate it as well. So obviously get back into the program. Leave your comments on how you're seeing some of the stuff. Some of you will disagree with some of the comments that we've got, and that's absolutely fine. We appreciate that. So let us know how you're seeing things. Smash the like button. And Blake, I think let's probably crack on with the proceedings, because obviously there's a lot to discuss and a lot to catch up on. Let's go topical thunder. Right, Blake, I want to start with earnings because I think it really is a very important subject. Look, we've seen, quite a lot of companies coming out so far, but those companies who have beaten, about 83% of companies who've reported have beaten the street's expectation, which is a pretty good number, one of the strongest numbers we've seen for a while. But obviously the companies that have beaten by an average of 7.3% on earnings. Now, a lot of people focus on the very, very low realised volatility in the S&P. We've got 10-day realised vol at 5.3%, which is sort of year-to-date lows. But within a single stock level, we are seeing increased dispersions playing through. The average stock has moved up on the day of earnings or down on the day of earnings by 5.3%. That's the greatest level of realised volatility or movement, one-day movement on earnings since 2012. So we are seeing some big moves playing through. What I want to take out is that Meta and Microsoft have smashed expectations in the after hours. That's important. There's been a lot of conjecture, a lot of concern that these companies, the hyperscaler businesses who have injected a huge amount of CapEx spend for this year and into the future, are not going to get the returns on investment. Now, the Meta numbers are showing signs that they are starting to monetize that. Ad revenue strong. Impression strong. Their guidance was strong, but much stronger than expected, or certainly stronger than expected. Their level of capex has gone up by another $30 billion. These guys are showing in Microsoft with their Azure department that they're de-risking the business, that this huge level of capex spend is going to get the return on investment that they bet the house on effectively. And that's really a huge win for these hyperscaler businesses. It's a huge win for AMD, for NVIDIA, and the companies producing GPUs and ASICs chips. And I love it. I think, the movement we're seeing, the extent of the beats, I think 42% of companies have guided to higher earnings, which is one of the highest levels in a long time. So I think it's a material thing to start with because it is boosting the S&P and the NASDAQ, and it's seeing every dip being bought at the moment. Obviously, we've got Apple, we've got Amazon, we've got some of the retail trade favourites coming through in the session ahead. How are you taking this out?
Well, the gap ups that we're going to see in both Microsoft and Meta tomorrow are at new highs for the year. And that's just going to carry the market. Obviously, S&P is going to trade up higher, probably about 20 or 30 points when Globex opens here in a very short period of time. But you get so many people, especially if it's easy to be in your own echo chamber and an echo chamber that you hear, oh, the economy's having a tough time, and you listen to a lot of economists, and you have to segregate the difference between Wall Street and it's the stock market is not the economy, and you're actually seeing these stocks look great, and it's giving us some great trends. I'm really interested to see Apple and Amazon tomorrow. Apple to me is more of a, I know you said it's not necessarily a play right now. I think it's more of like an electric company type of new age electric company.
Yeah.
And Amazon is more of going to give us a retail kind of a see how retail globally is playing out.
Well, the AWS side of things working really well as well. But I agree. Apple is, they've lost people to Meta and AI heads into Meta. It's a 2020 story, 27 story. I mean, they've still got to get their AI game on track and get that one running. Everyone else is making inroads and going. But I think there will be a time when Apple has a really good run. But it's at the moment they're tracking sideways and they've lost that catalyst, right?
Do you? Yes. And by the way, do you guys use Microsoft's Copilot?
Copilot, that's what we use. Yeah, okay. That's we've moved from Google to Copilot.
I have zero success with Copilot, and to me that's just more of a personal.
Well, the numbers that they came out to 100 million monthly users using Copilot, so they're monetizing that one now.
Everybody needs help with PowerPoint, I guess, and Excel spreadsheets. So
not you, Blake.
Well, you know what? Some people need help with. If you're a dollar bear right now, you probably need a little bit of help. So let's shift the conversation to the dollar.
Absolutely.
And it's great to get you guys all up to speed on what you've missed the last couple of weeks. But as we were, kind of signing off with the trade-off show, we also were signing off with the idea that the dollar is going to start gaining a little bit of strength, and we're kind of midstream right now. The dollar really broke out today and yesterday, following the trade deals that we're putting together with the one with Europe, and obviously the good data that we had today, the FOMC, a little bit more hawkish tone. We'll talk a little bit more about the Fed here in a moment, but the dollar, you got to. I want to ask. Well, I'll ask you a couple questions here, Chris, because it really kicked off with the euro, and I was like, okay, this European U.S. trade deal was going to happen. I was long euros going into not the euro dollar, but I was long euros against some crosses going into the weekend. And first thing Monday morning, soon as Europe stepped in, everybody's like, bad trade deal, euros under pressure. But now we're starting to see the dollar really rally on its own accord. So I wanted to ask you, do you think this is more of a euro move, or do you think it's more of a US dollar move, or maybe it's a combination of both, which is in itself, it's very scary considering the overall sentiment of the dollar the last several months. So where are you at as far as the dollar goes?
I'd say it's predominantly a dollar move. I mean, yeah, we can talk about euro, but I'm not necessarily sure the EU US deal was that bad. I know everyone in Europe's saying that we've been absolutely shafted on the back of this, and but I think you've seen the dollar move up on a concerted basis overnight, and maybe there's some short covering coming through. The implied probability of a rate cut in September has come back down to 45%. Obviously, payrolls on Friday is going to be the clincher for that one as well. But yeah, I think you've really seen that short position, the base that's come through, just being unwound a little bit. There is a bit of a difference between the short-term short positioning and that structural positioning where over the last 3 decades you've seen that massive wall of capital going into US equities in this exceptionalism story, and some of that money that in foreign investment has been hedged out. And I think that's still more to play, and that should cap the dollar move to the upside. Right now, the technicals are breaking down in euro dollar. Yeah, they're moving up in the US dollar. That's going to be a lot down to what happens in the FOMC, in the non-farm payrolls number. Also, another one that probably is a small underappreciated situation is after the Genius Act and the idea of making stable coins a more sort of a future payment system that's going to be used much more liberally and a much greater adoption. Well, Trump's essentially backed the US dollar as really the only currency in town attached to that. And if stable coins are the future of payment situations, well, the dollar's underpinning that. And that, again, just reinforces the idea that the dollar's going nowhere as the reserve currency. That's probably giving it a little bit of bit of love as well. But I don't think it's the short term. I think there's probably a bit more juice in the upside in the US dollar in the short term. Are you on that train?
I am, and I've got some charts to show how I want to express it. I think you probably do too.
Ooh, cat out of the bag. Anyway, let's go to Fed policy, because we talked about that list. I mean, I think what you've a lot of people talked about this idea of two governors dissenting within the Fed board, widely expected. Michelle Bowman was probably a little bit more iffy, but she's dissented and called for a 25 basis point cut this meeting. Obviously, Christopher Waller had made his points very, very clear. I think basically the cynic, is it cynical to say that they basically certainly Waller's put his hand up for the Fed chair role for in this situation, and I'm sure Trump's loving him for it. But yeah, it's a very rare situation that you get the one Fed governor dissenting from what is traditionally a very cohesive and very homogenous group. The Fed chair corrals everyone into thinking the same, and it's very, very different to see the rates market pricing in 1-2% probability of a cut, giving absolutely no chance, and then two major powerhouses within the Fed going against that. That's a very weird and odd dynamic. And again, some people would say that politicizes the Fed. But yeah, like you talked about it being slightly more hawkish. I mean, that's obvious. It's not, you're already sticking your neck out there when we've seen the dollar rally, and yields across the curve have moved up a little bit. So I think, the market has clearly echoed what you've just said. The question now is that can keep. I don't think we've learned any more. I mean, I think really what you've seen from the Fed there is that they really want to wait for the tariff situation to kick in. They want to wait another couple of months worth of data just to see how that feeds through into goods inflation, and where that sort of settles up and what happens with the pass-through to the consumer. Once we've got that conjecture, maybe they will be in a position to cut through by September. But the Fed effectively have two more payrolls number and two more CPI prints before that September note. And maybe that data then will give them that clarity to either cut or give them the confidence to keep rates on hold. But that's probably what we're seeing. We'll continue to be wait and see.
Well, data dependence, right? And then as you pointed out, this is going to be a very important jobs number that we get.
Yeah.
And it'll tell us how close we are to thinking September is a go or not. But one of the things, and I made this point on another show today, is one of the things that we as traders and investors we don't like uncertainty.
There's always uncertainty. It's just different degrees of uncertainty.
There's a lot of uncertainty, and guess what? China and the U.S. are probably going to go on at least another 3-month hiatus, trying to figure out what they're going to do as far as trade and tariffs go. And the Fed, they've got their hands tied right now. They can't really do anything because the labor market's still solid. Yeah, are we seeing some signs of weakness in some of the underlying data? Sure, we are. But and has inflation come down? Sure, but we don't know what the effects of the tariffs are going to be and how they're going to bleed through over the next couple of months, and especially if China and the U.S. just all of a sudden throw up both of their arms and say, you know what, screw both of you, we're out. And then next thing you know, prices are going higher across the board. Last thing the Fed wants to do is cut rates and then have to raise them again at the end of the year, to heat off some. Can you even imagine? But I think the sort of consensus view from economists is that core PCE is going to rise, perhaps up to 3.2, 3.4% by Q3 in average in Q3, and then it will slowly gravitate down into 2026. At that point, when growth will slow down as well. A quick question while I've got you before I get a big nasty smack on the bottom by our producer. Payrolls number. For me, the most important thing is the unemployment rate. I think the Fed have made that clear that the unemployment rate is the most important thing for them. Where do you see the balance of risks for the dollar, for equities on the back of this tonight? Well, talking with the guys, on my team, we're all pretty much in the camp that I don't think this month is going to be the month that we're going to see the weakness in the labor data. Now, it could be. I mean, obviously. And the dollar's kind of leaning into it's not going to be, but I would err on the side of, hey, if we have anything, we have a headline number above 50,000 jobs, there's nothing to really, write home about. I wouldn't be selling into any type of weakness personally. Now, as far as the unemployment rate, let me I forgot because the data, it's late in the day and I'm trying to think about
4.2, 4.1 at the moment. 4.2 is expected.
4.1, and that's what it was last month as well. I mean,
4.2 is expected, I think, just a slight tick up.
Yeah, I mean, if it comes in one tick higher as expected, do you really worry about that? Is that concerning, especially when weekly unemployment claims are still coming in below 420,000 or 220,000? Excuse me. Did I say 400? I meant 200. Yeah. 200. But you know what I'm saying? It's like the jobs market doesn't look bad. I have to see it completely upended, kind of like the Aussie CPI was 2 days ago.
Well, I think the equity story is going to be the easiest one. The dollar has to look at unemployment rate, revisions, net jobs, average hourly earnings, and it chooses which one they wants to go with, and they could be conflicting. The equity market is a more simple beast in this situation. What fulfills Goldilocks? I think 95 to 120,000 jobs is, that's a good number. Market says fine in that range. We're happy. We're still creating jobs. An unemployment rate ticking up to 4.2% doesn't trouble anyone. Average hourly earnings is fine. So I think the market, the equity market, saying, look, as long as we're seeing a reasonably healthy market without any red flags, we'll just keep pushing up risk. The dollar needs to look at whatever it needs to look at, which makes it a little bit more difficult. But I think the unemployment rate for me is probably the most important factor.
I'd agree. I'd agree with that. And I know we need to move on, but I would also argue that as long as the number, like I said, 50,000, it's not, everybody would look at that and go, oh my God, it was a horrible number.
It would be a horrible number.
Then again, everybody would say, good, we're going to get Fed cuts like in September.
What a horrible bunch of people we are. Willing low jobs. Yay, capitalism.
Capitalism. There we go. Woohoo. Okay. Anyway, let's move on to metals, Chris, because this is obviously hot topic, not only amongst your group of traders, which is very Asian based, but also it's just, and I say that because I want to make a point in a few other charts, so make sure you all stick around for that. But we're really starting to see some weakness in gold, and gold has broken a uptrend that's basically had it captivated all of 2025. We've seen a move down in platinum. We've seen silver start to shave off some of these gains. And obviously, I don't want to. We could talk about copper. Copper was like a holy cow. Did that just drop 16%? Like literally
sliced up.
I'm fortunately, I had no copper exposure or anything like that. I was telling people on my week ahead video, I was very weary about it being up at these levels, but I wasn't short. It's just, boy, that came unglued. Forget copper for a second, but I want to talk about gold. Gold has not acted well for months. We've talked about this literally for months, and we've been looking for some sort of catalyst, but it's really one of the things that I wanted to discuss, and something I discussed last week on my week ahead video or actually 2 weeks ago, about the market recorrelating. And I'm like, soon as gold starts to break that trend line, I can't be short dollars anymore. And that was my cue actually on Monday afternoon, going into Tuesday morning for you guys. I was like, look, I can't be short the dollar anymore because gold was starting to break down. And I was thinking, okay, I was with you. EU deal's not so bad. I mean, it's favors for the US. But anyway, I cut that. I turned around, went long the dollar because I think the market's recorrelating now. So gold, I think, has a lot of implications. How are you seeing gold right now where it trades?
Well, I firstly want to just pick out that picture that's in the top right-hand corner of the screen. And are those actually bits of gold and copper and silver, or are they someone's just wrapped little bits of foil around some sort of breakfast cereal or something like that in the morning? Awful picture, terrible producer. Anyway, to answer your question, I think, you've seen high yields on the day. They're still 10 years trading on a bit of a range. So the 10-year real rate's still sort of trading, around that sort of 2% level. But I think for me, it's this re-emergence of the US dollar. I think people have just started to say to themselves, well, has this actually got legs? I mean, we just don't know. I think the fundamental argument for the dollar right now is quite symmetrical, delicately poised, but the technicals right now suggest there could be some further upside in the dollar. And if we get a strong payrolls number this week, then obviously, that implied probability of a September cut probably goes from 45%, 35, 40%, and the dollar continues to march up. And the gold market it will take its directional cues from anywhere. Tariff, anxiety around tariffs, geopolitics, whatever it is. And we don't really know about it until whatever that time is. But the Chinese aren't big buyers at the moment. The flows have sort of dissipated into the gold ETFs. And for me right now, and we talk about this every single time, is when it comes to gold, price is the only fundamental you need. It just aggregates whatever the market's feeling. And right now, it feels like this breakdown that we've seen through the recent lows may have to kick. The gold bulls are going to have to do some searching. They're going to have to do some soul searching and turn this one around right now. Because if this US dollar does have legs, and it's a big if, I obviously don't know the answers to that. And if we were to see a little bit of upside coming through in the real rate story, then this move in the gold price has got further to run to the downside, in my opinion. Copper's it's obviously a different one because that's down to the tariff situation and what's happened and what Trump left out in terms of refined copper. But everyone in that market has been playing this long CME, short LME copper basis trade or copper spread trade. And that premium of CME copper to LME copper had blown out to nearly 30%. There's a lot of people hurting today after what they've seen. A lot that arb has effectively come in pretty hard. And I think there'll be people who are slow to that move have been hurting on the back of what we've been seeing today. But that's a different situation from the copper move. Anyway, let's talk about some of these dollars. Go on, sorry.
No, I was going to say a lot of people might have left the business this over the last 24 hours.
Well, I mean, to be honest, when you've got a 28%, nearly 30% premium between the two, and you've got copper, CME copper at those highs, not just because of better growth prospects around the world, or some of the soft data points have improved, but because of what we've been seeing in tariffs, you say to yourself, well, we've probably made some money out of this. What happens if Trump doesn't do this action and doesn't include refined copper in the tariffs? Is it worth just taking a little bit off the table? We've probably made the money on that. That spread's not going to widen anymore. It probably would have been worth thinking about that. I wasn't in the trade, so it's not even something I considered. But I'd imagine someone who knows a little bit more about it and is, in an institutional world, they probably would have seen that as the big risk, and they should have dealt with that position before. But anyway, let's go to the charts that matter. Let's go to that's the setup. All right, we've got a bit of euro action going on top too, but let's start with euro dollar and see if your euro Swiss is any different, and obviously we can combine that into dollar Swiss. But I look at this chart right now, this big picture stuff, it's daily chart action, and it obviously gives you a really good sort of overview about the supply and demand and the aggregation of the flows that have gone into this price action. This really strong move that we saw up into 118 through the most of the year, concerns about the exceptionalism story, concerns about relative growth, all these factors playing through, and obviously hedging of foreign of US investments from foreign entities has caused the move up into 118. But now we've sort of seen that coming under pressure, and we've started to see the volatility pick up a little bit. That 50-day moving average has defined the bull trend that's been moving up. We cracked through that reasonably convincingly. We got through the horizontal support. We're now trading below the short-term moving averages. It feels like this is now turned into a seller's rally, or rallies are to be sold, shall we say. And I feel like, if you're fundamentally opposed, you're probably looking to pick this one up again at sort of 112 as your value area, as a buying opportunity. But yeah, look, I look at that big picture stuff and we can define that into 4-hour charts, work it into 1-hour charts. If I look at that right now, where do I see the probabilities? I say they're probably lower. That would be the directional sort of skew that I have. Selling rallies seems to be the right call up into that 5-day. That'd be the way that I'll be looking at it. I think this goes lower.
All right, Chris. Well, I'm going to tell you the Euro Swiss does look a little bit different than the dollar Swiss. But last week I put together a video on the Euro Swiss, just a short video saying this is like my favorite setup going into the end of this year. Now, one of the reasons why I believe that, Chris, is I think yields are going higher. And if you look at the dollar Swiss, yes, it's almost a mirror image of the US, or excuse me, of the Euro US dollar. But the difference here is when you're talking about like the Swiss franc, just in general, there are risks that Switzerland's going to take the rates down to negative rates. And when you have a move, like we've seen in the dollar, and maybe with the Fed, where the market has to price out the potential of not having, not getting cuts in September, that's going to just weaken the argument for the Swiss franc just as a whole. Now, as far as the Euro Swiss goes, we're on a lot of support around the 618 retracement. And not only did there's an analyst, his name's Brent Donnelly. I was reading his stuff yesterday, I think. And then one of my teammates have been talking about, Swiss franc has just had this just massive every month at the end of the month buying of Swiss francs. We're at the end of the month tomorrow, and if we can hold around these levels, I think we pop right back up to the 50 DMA. And I do believe this is going to be a great long going into the end of the year, as some of the risks from, hopefully from the Russia-Ukraine situation subside. The Israeli-Iranian situation, hopefully that calms down a little bit, and then we could see some pressure come out of the Swiss franc. So the Euro Swiss, I'm looking for it to trade higher into the second half of this year.
2 questions, very quick ones. Mm-hmm. Firstly, where do people see that video? And secondly, that oscillate, that technical indicator on the bottom chart, is that the price within the Bollinger Band whip?
No, that one at the very bottom is showing you how tight the ATR is. That's the daily ATR. Yeah, and relative strength. Everything's just kind of coiled up down here. But you can see there's so much support down below the markets. And you can find that video just on X. If you follow me on X, you can find that from late last week, I believe.
Get in there, mate. Get in there. All right. Well, I'll look at that one very closely. So should everyone at home. Check that one out. See what's going on for the second half and Blake's pick of the bunch. I want to go to Bitcoin because whilst we're seeing a lot of these high beta tech plays in the US absolutely mooning, we've seen that at Microsoft, and have a look at something like advanced micro devices, which I think is up 7 days in a row, and it's just a crazy move at the moment. But yeah, Bitcoin. Yeah, we're hearing about. We had the aftermath of what happened in stable coins, and obviously the different acts, and that was more of an Ethereum play given what we're seeing there. Bitcoin didn't really get the sort of the move, and we'd obviously seen a lot of people looking to trade the Ethereum Bitcoin differential, essentially long short. But I like the price action and this. I think this is one obviously that it's. You've got to wait for the market to reveal itself. You've got this nice move up. You've got the contraction in volatility, the contraction in ranges. The market doesn't really know what to do. You've got all these different companies coming out and talking about now that are putting Bitcoin on its balance sheet, becoming these kind of corporate treasurers essentially. But the price action is not reflecting that at the moment. And you're seeing the market just not sure what to do with this Bitcoin price at the moment. Can we push this up? Can we sell it off? There's no one who's making that authoritarian play. And it will happen. You'll get that breakout. The volatility contracts, the ranges contract, Bollinger Band whip comes in. The longer that goes on for, it begins this coiling motion. And what I like there is this setup right now, because one party needs to reveal its hand, and that will set you up with a probabilistic outcome of future direction. So I'm waiting this one out. When the market reveals itself to the upside or to the downside, I think that's when we can look at new trends developing. I think obviously for the ultra short termism out there, like you can take this the fact that we do have this defined and contracted range gives you a really nice way of trading this long and short within a much lower time frame. Get on the 30-minute charts and work that one in, long and short within that range. And I think that's the way to play this right now from a tactical trading perspective. But from a big picture situation, people wanting to know where the future direction is going to go, this contraction in or compression in volatility and range will reveal itself, and I think it's going to be quite powerful. So this is one that's firmly on the radar.
Yeah, and I mean, let's not forget, Chris, we're consolidating at all-time highs. That's usually not a bearish sign.
No. 80% of the time it sort of reconciles itself with the primary trend, right?
Yeah, and I mean, while you're above 112,000, I don't think there's any reason to be on the short side of Bitcoin. Anyway,
you just need Mr. Trump to come and pump it up.
Yeah, that's right. Come on, crypto hodlers, everybody unite. All right, let's talk about uniting. Let's talk about gold, and this is the chart that really has my attention right now, and that's the trend line I was telling you the whole year. 2025, we're following up along that trend line. Great up until this week or this last week, and we started to briefly break below. We were consolidating, and then we really started to break down just a couple of days ago, following the EU-US trade deal. Now, I always think, from the point of view of who's on the other side of the trade. Now, I have no skin in the game in gold, although I am long dollars. So what I'm hoping happens is gold breaks down, the dollar continues to rally. That's my play. But I'm not short gold, but I think if you own it, you have to start looking at that 3248 level. That's a 618 retracement of the last time that we had a higher high. And then you can see that low that was, we touched basically the 50 DMA back in May. So we start breaking below 3248, which is 3250. That's when you start breaking horizontal support, the Fibonacci golden fib level. I think it's a one-way ticket to the 200 DMA. So if you're long and you're concerned, I think that's where most longs are like, you know what? I have to reassess this and I want to get out. So if you're a predatory type of trader and you're still looking to be on the short side of gold, I think below 3248, that's when it opens up the downside. And for those of you that are long, the one thing you're going to want to have is you're going to want it to get back above the 50 DMA. That's that light orange moving average. That comes in around 3340. We have to get back above the 50 DMA to negate everything that I just said.
You can do it.
You can do it.
As they say, the trend is your friend, but don't let it become your girlfriend. Anyway, let's move on to the play of the day. Come on. Oh, right. I'm going to go to NASDAQ 100.
I think the DJ fell asleep behind the wheel there.
Yeah, I know. He's left us hanging there. I think that was a purpose. That was great editorial skills on his behalf.
Somebody's been on vacation.
All right, let's go to NASDAQ 100 because that's my play of the day. Look, it's hard to buy the NASDAQ at all-time highs. Hard to buy anything at all-time highs. 2024 showed us that buying things at all-time highs made a lot of sense and actually returned some decent alpha. Now, I'm only saying this because I might want to go and buy this and actually look to offset this and go long and short and trade the relative performance. That's a better way to play things at all-time highs. But these numbers from Meta, fantastic. I mean, that's kind of encapsulated in this chart. It's just grinding higher on low volatility. You've got still holding these short-term moving averages. Microsoft numbers, fantastic. You just don't see a stock with that sort of market cap moving 7% unless you're NVIDIA. I think you're going to get the outperformance from tech. NVIDIA's numbers don't come through until the 23rd of August. We're going to get some of the other numbers, names like AMD there as well. Look, there are concerns around what happens with chips and, going to China. Will we get NVIDIA and AMD allowed to offer most of their chips through? That obviously has been reported. But I think, if you look at the ability now, what we're seeing clear signs for these hyperscaler businesses to start getting a return on that level of CapEx, I think this is just going to propel tailwinds. Now, one of the things that we're also looking at, is this a US story in the returns we're seeing, or are the other businesses around Asia, your Tencents, your Alibabas who have made a big push into AI and inference, are they going to see the sort of returns that we're seeing in Meta and some of the agentic AI businesses as well? ServiceNow is doing some really good things in that scene as well. If it does seem that this is more of a US story, perhaps that exceptionalism story comes back into its throne as well. So I think, the NASDAQ just looks good on a technical basis. There's no reason to be short at this moment from the big picture situation. Obviously, there are risks coming up. I think, liquidity is going to be a big issue as the Treasury general account starts to rebuild. A dollar rally would potentially be a headwind to Q3 earnings. It's been a tailwind to Q2 earnings. And again, a lot of people just look at this and go, there's no way I'm buying a market all-time highs. But I think the story from what we've seen from Meta, and we want to see Amazon as well. Amazon's just such a love stock that it will need to blow the lights out. But, for me right now, this is the market that looks really strong.
It looks, how underinvested is the rest of the world right now? As they've been deleveraging away from the US and into the German DAX or the Nikkei or whatever else. How about if the rest of the world needs to get some more exposure to US stocks? Where does that?
That's right. And then people start going, maybe just hold off on our plays to hedge out that exposure. I don't know, but I think you need to also think that earnings are the fundamental driver of this right now. And we're seeing better earnings, but you've got to look at all the flow-based effects. Low volatility pushing vol targeting funds into the market, CTAs adding length. You've got this gamma squeeze coming through as NVIDIA options, people buy calls and it pushes it up, and some of the retail trading names go up. Retail traders have been huge influence in US stocks this year. So all the flow-based effects continue to suggest this. The market all time, just the chasing of returns is just such a powerful force as well. So the way I like to look is I look at this chart and I say, what does the emotion, and for people who need to perform when they see that, they've got to be in NVIDIA, they've got to be in AMD, they've got to be in Broadcom, they've got to be in Amazon's, you've got to be in your Microsoft, absolutely got to be in Microsoft as a core holding. You've got to be increasing that exposure on today, and that's just going to see the relative performance in the NASDAQ outperform, I think.
All right. Well, Chris, that's one hell of a chart there. All right. My play of the day is going to be something that I just picked up today. Ooh. And I didn't even mean that to rhyme, Chris.
Yeah. Well, you were going to say.
Play of the day. I actually picked it up long today. The Loonie. It's time to get a little Loonie, in my opinion. This is the dollar CAD. One of the things, you could sit and say, fiat sucks. You got to be long gold. You got to be long Bitcoin. Yeah. Whatever. I agree. But when you're trading fiat against fiat against fiat, you're thinking about economies versus one another. And frankly, I'm in the camp that I think Canada is going to have a little bit tougher time than the U.S. moving forward. Also, Canada. Don't forget, August 1st is only 2 days away, and Canada has not secured a trade deal. Not saying they won't, but they're at risk of higher tariff rates, up north of 30% right at this point in time. Now, the dollar CAD has broken out of this nice base that we've had. I am looking for dips back to 137.70, which you might even get overnight. We're trading at 138.30 right now. But any type of dip like that should lead us to an eventual move towards the 200 DMA. A full extension of that triangle takes us to 140, slightly above 140. And I'm looking to play this base on the long side now. So this is my dollar play going into one of my dollar plays going into the next couple of days. And I wanted to share it with all of our esteemed viewers here at the Trade Off.
Well done, mate. Very, very good. Very good. Very good. Very good. Anyway, thank you very much, everyone at home, for playing along today. Obviously, if you got some views on where the dollar's going, what you think is going to happen on this breakdown in gold, do we get the reversal back to the levels that Blake was talking about? Do you think that equity's got more juice in the tank, or do you think just the risk reward now favours being short into this uptrend? There's a lot going on, a lot of different debates which are forming in the market, and of course everyone's going to have different opinions. Those dispersion opinions, what potentially could cause a bit of volatility. Blake, good to see you, friend. I'll see you next week, and for everyone at home for playing along, see you for next week.